Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. The market climb continues with earnings season now in full swing. Companies reporting thus far have been able to meet, beat, and release some more guidance after a semi-paralysis in communication due to the tariff unknowns. While tariffs are still unknowns, the one big beautiful bill has passed and a larger pond for investors to fish in has opened up across the globe. Concerns about the Fed and the bond market are not going away as this wall of worry continues to be tackled. Joining us here to bring context to what this moment in the markets could mean for you and for your clients is Fidelity Director of Global Macro, Jurrien Timmer. Hello, Jurrien. How are you? Happy Monday.
Good morning. Good morning.
So a moment in the markets, it is kind of fascinating. There's a little bit of complacency. Things, as we say, climb this wall of worry. What are you seeing in this moment?
Yes, if you look at what the markets are doing, the stock market is making modest new highs. The Mag 7 continues to power along. Global markets are very much participating in this, which is great to see because it really shows, like you said, a bigger pond that we can all fish in is obviously better than the last 10 years where, it was a very binary choice that if you were in this space that worked, then great, but if you were not, you were really left behind, and that's no longer really the case. But we're starting to get some animal spirits back. If we go to slide 7, the non-profitable tech stocks, these were the darlings of the 2021 liquidity bubble. Remember when we had COVID and we had all that fiscal helicopter money that the Fed was essentially monetizing, and then it stayed too accommodative for too long. That created a liquidity bubble, and we had the whole meme stock frenzy. That, of course, unraveled as they always do when rates go up. And for the last few years, those stocks have just been sitting at the bottom, down 50%, but they're starting to stir a little bit. And so, whether that's complacency or not, I'll leave to everyone to conclude for themselves. But when you look at the two elephants in the room, they're still there, right? One is tariffs, and one is the fiscal side with bond yields possibly, pushing up towards 4.5 and 5 again in the future. Those two risks have not gone away. I think the market is just concluding that, whatever, we'll believe it when we see it in terms of the tariff stuff, because we've had so many back and forths on, threats and then supposedly deals and this and that. So I think the market has kind of gone from pricing a left tail to back to pricing a right tail, driven by the big beautiful bill. And in the meantime, the earnings story, which earnings got marked down right back in April, if we go to slide 4, they are getting unmarked now because the worst case scenario for tariffs has not yet materialized. Maybe it still will, but earnings growth estimates got marked down by about 400 or 500 basis points back in April. And now we have the big beautiful bill. We have tailwinds from a lower dollar, which tends to boost earnings for U.S. large cap companies. And what we're seeing is that earnings season, which is now a week underway, is already seeing the customary bounce. The growth rate for Q2 earnings coming into earnings season was 2.5%. We're now at 3.8 or so, and that is very likely to continue in the next few weeks. So the earnings story is good. And if we go to slide 3, the valuation story, we're back to valuations amplifying earnings rather than offsetting them, right? So we've talked about this in the past. 2023 and 2024, we saw a big lift from valuations. And then, of course, earlier this year, we saw the opposite. And that was always my sense, is that, this will be a more two-sided year where earnings would grow, but valuations would compress. Right now, and it's just a snapshot in time right now, we have valuations up about 8% year over year, earnings about 10 or so or 8, and then dividends is 1, and so you get a pretty good performance profile. But again, we're only halfway through the year, and again, those elephants have not left the room yet.
Right, but the earnings picture has been. There was a lot of concern about Q2 because that was when all the announcements came, and there was this a little bit of a paralysis by companies because they just didn't know what they were making decisions on, so they sort of put them all to the side. Are you surprised thus far that we're not seeing more evidence of that, or actually have certain data sets leading up to the earnings season kind of allowed us to think that, yeah, earnings are okay, we haven't seen anything disastrous?
It's a great question, and actually we can pull up slide 5. It's hard to know exactly where the different pieces will land, right? So if tariffs are an import tax, I mean, that's basically literally what they are. We don't know who is paying the tax yet, right? Is it the consumer? Is it the importing company through lower margins, or is it the exporting company because of a threat of substitutions or what have you? But one thing we do know, if you look at this chart, that gray line at the top is the operating margin for the U.S. stock market, and it continues to make new highs. So again, it's early, right? This only just happened the last few months, and so we're not going to necessarily see this yet. But so far, the margin story is holding up, and margins definitely are a driver for valuations and, of course, for earnings. And again, how do you offset the pressure from tariffs with the boost from the big beautiful bill? And so we just really don't know yet.
Yeah.
There isn't a lot of evidence that it's all being paid for by consumers. They're not as flush with cash this time around than the last cycle. We don't have all those COVID era transfer payments going on that we did the last time there was a fiscal impulse. So it could all just be kind of offset by each other. But generally, the thinking is it should add a little bit to inflation and take a little bit away from margins, and you get into a very mini sort of stagflationary type of mode. But so far, there is really no conclusive evidence that of any major direction with the tariffs, and that's may just be because the tariffs so far are not that onerous. They could get worse or not. And also you had companies front running orders, right, before the tariffs would go into effect. So who knows how much of the data is even reliable at this point. And actually just one more point on the inflation component. I'm not an inflation expert or an economist, but apparently with all the federal layoffs, during the Doge days, that a large chunk of how the CPI is measured is just sort of fill in the blank stuff because they don't have enough people or systems to actually track prices anymore. So that's kind of another little dimension of that.
Okay, that's really interesting. That also needs to land with, I guess, some clarity, one way or the other. This is also something you won't have an answer to, but I'm curious. I think probably Canadians are curious, watching the tariff negotiations with the EU right now, which are getting heated, which is part of the process. Just your thoughts generally. Like, it is getting a bit heated there, and maybe they'll make it to a good deal or a bad deal. We don't know. But I just wonder if you have any sort of impressions on some of the negotiations on tariffs thus far.
Yeah, the Europe story is interesting because the former prime minister of the Netherlands, Mark Rutte, is now the Secretary General of NATO, and he was at the White House. We generally, Dutch people, have been a big fan of his. And he's handling that kind of that whole situation pretty well, and there's some good cooperation now with NATO, and now all of a sudden Putin is on the hot seat. So I guess it's a reminder that with this administration, you just never know.
Okay.
What's hot today is cold tomorrow, and what's cold today is hot tomorrow. So I think the market has resigned itself that that something will be, some deal will be made. And if it's not, the markets will essentially punish the non-deal makers to the point where they'll have to make a deal. And that was one of the lessons from April, is that the markets do still have a voice. We were worried in March and early April that they were going to plow ahead with this stuff no matter what the markets do. But the markets do always win and do always have the last word. And so I think whether that's complacent or not, I think that's generally the vibe in the markets, because the markets are very quiet, even though the headlines are not. Maybe that's complacency. Maybe that's everyone's being at the beach, in July. But it does tell you that it's like machine learning, right? Like fool me once, that sort of thing. And so the markets are now, okay, we'll believe it when we see it.
Okay, fair enough. Speaking of the beach and hot under the collar on negotiations, let's go to your heat map. Actually, it just takes a look at the asset classes that have been on fire. Some of them, actually.
Yeah. So slide 15. So it's very interesting. You look at this is the periodic table showing 3 month returns on a rolling 3 month. Annual returns on a rolling 3 month basis. And on the top are Bitcoin and the Mag 7. And it's like, on the surface, you would think, well, what do those two have in common? But they're both favored destinations of people expressing risk appetites. Of course, the Mag 7 are the powerhouse that they are. And Bitcoin, when risk is on and the fundamental sort of narrative is working, which in this case is global liquidity growth, and you combine that with a rising market, Bitcoin does very well. And of course, we know, at 120 or so, it made new highs last week again. We had the Genius Act, which certainly fuels the fires of the crypto world even more, and we can talk about the Genius Act in a moment, but crypto is now a $4 trillion asset class when you include the stable coins, so pretty impressive. So those are the two at top, and of course S&P below that, and at the bottom, it's the same victims we've had all year. It's long treasuries and the dollar. And I mean, that kind of tells you everything you need to know about where the priorities are, that treasuries and the dollar are no longer the safe haven asset. And certainly when we think about not only the next 6 months, but the next 5 years, and we think about all the attacks on the Fed's independence and the need to finance all this debt, and the risk that if the Fed were to become sort of a puppet of the administration and it lowered rates when it really wasn't justified, you would see the yield curve bear steepen, and that would put pressure on long rates and the refinancing there. And so I think that all plays into both the dollar and treasuries as the weakest links in the chain here. And if we want to speculate even further, we can think about, okay, let's say Powell, of course, is out next year, whether he gets fired tomorrow or stays out his term. Someone will come in who is more friendly to the administration, and we already see this circus unfold, that people on the Fed are very blatantly and obviously, parading around looking for the job. But if you get to a point where the Fed does lower rates beyond what is justified, it would almost immediately then have to go back into yield curve control to keep the long end down, because if they don't do that, then the curve will bear steepen and everyone loses still at that point. And so then you get into kind of a Japanese style financial repression era. What does that do to the dollar? And so these are all kind of the things that are lurking in the bottom of that chart. And you can argue that if that happens, if you have real financial repression and devaluation of the debt via low real rates and a weakening dollar, then places like Bitcoin and even non-profitable tech stocks could go to the moon, because then you get this very impulsive move up, at least in local terms, maybe not in US dollar terms. So I think that this heat map is kind of already hinting at where the cookie is going to crumble.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
As you said, and to an extent, that's showing where it is priced in, maybe not fully priced in, but starting to get priced in. There's a question, we were going to talk about margins, and this goes to sort of the earnings story and the margin story within, and they've been very good. It's specific about metals. So I'll just put it to you. Do you think that tariffs on copper, which was the massive story 2 weeks ago, aluminum and steel will have a meaningful impact on margins, earnings, and overall economic growth in the U.S.? This is the question of where we find it in earnings. Yeah.
Well, if you look at the sector performers, I don't have the chart this week, but the leaders are, of course, tech, communication services, financials, industrials, and the losers are energy and kind of materials are in the middle. So that would be kind of the copper, steel play. I mean, the notion of like tariffs on steel, I can kind of see because I believe we produce steel in the U.S., but I don't know that anyone produces copper. You can't just like take a copper mine out of some other part of the world and plop it in here. So I don't know how logical that is, and of course, a lot of logic doesn't always enter the equation when it comes to these things. But that of course could affect margins. But I will say that where's my chart? Slide 13. When you look at emerging markets, there's some really good action there. And if you look at the bottom panel, that the orange is a detrended chart of the commodity markets. This is the CRB raw industrials, and you can see that tends to coincide with cycles for emerging markets. So these are both Z-scores, and so it does look like a new kind of commodity bull market is underway, which of course helps emerging market stocks. And if we go to slide 14, just looking at the Bloomberg Spot Commodity Index in the top, and this is the Goldman Sachs equity basket for commodity producers in the bottom. It's not a bad looking chart. It's not going vertical by any chance, but the stocks in the commodity space are holding up pretty well. And as the commodity space itself seems to be building some sort of rounding bottom. So I'm positive on the space. And again, the tariff stuff, like I think the market has concluded that you just never know, and ultimately the markets will speak and decide these things.
Yeah, fantastic. If we go further into the earnings picture, which is sort of earnings for sure, profitable tech, you were speaking about that before. I wonder if this is the moment to sort of bring in the Genius Act and talk a little bit more about what's been codified, eventually how investors can take a look at this. And I think just the whole issue of stablecoins, we heard a lot about it last week. How should investors look to watch for this, either in companies or in separate new entities? What do you think?
Yeah, it's a fascinating story. And of course, Circle, which is the second largest stablecoin after Tether, and Tether is not a US company, so it kind of does its own thing. But Circle has been trying to do all of this by the book, fully reserved, full transparency, and it issued an IPO recently that was vastly, vastly oversubscribed. And so it tells you that there's real appetite for this industry. And it's interesting. We don't really know to what degree this will disrupt the legacy financial industry, as we call it, right? So if you're sending a payment overseas via SWIFT, it's a mess. It's expensive. It takes like 3 days. 4 different banks touch that money before it goes to the recipient. And the idea is that stable coins will allow for that to happen seamlessly, and you'll always know where your money is until it lands in the recipient's pocket. But this money doesn't come out of thin air, right? This is not like the money supply is all of a sudden going to grow 20% because stable coins are created. I mean, if someone decides to hold money as a stable coin, they have decided not to hold it in a traditional form, which would be presumably a bank deposit or something like that. So it could disrupt the banks in that sense, like it will make the banks less profitable with payments, and they might lose market share on deposits if it's a big bank that doesn't. So one of the things with the stable coins is that it can't pay interest, and that actually has its roots in history from a very long time ago. We used to have this thing called Regulation Q, because back in the 1920s, banks were competing with each other on deposit rates. And then each bank would pay a higher deposit. Sorry if I'm digressing here. And that would then, some banks would make unnecessarily risky loans or investments to be able to pay for those deposits. And so that created, moral hazard. So the government said, okay, regulation Q, you can't compete with interest rates. And that's when banks started to give out toasters and TVs when you open a large account. So this is like,
Yeah, they
so,
give
so
out
this
iPads.
actually,
Yeah.
yeah. So this actually is kind of rooted in that history where, okay, stable coins are not going to be able to compete on rates because otherwise it creates unfair advantage because banks are reserved and stable coins, I guess, are reserved as well. But so they're not going to play a function. They're not going to compete with our money market fund that's paying 4.5% and a stable coin which pays nothing. So the use case is for people to have utility over their money. It might normally be in a bank, but banks generally pay almost nothing on their deposits anyway. So there it becomes a question of access, of fungibility, and the ease of moving money around. But of course, the banks can compete with that because they can tokenize their deposits. And then you get into, okay, what does that do to bank reserves? What does that do to the liquidity environment? And so we don't really know where that is going to all fall, but it's certainly a disruptive change. And I think one that's generally a good thing. And of course, Ethereum is sort of the OG on stable coins. Half the stable coins are somehow not denominated, but are related to Ethereum. So Ethereum has a very large market share, and that's why Ethereum, of course, has been skyrocketing the last few months. And so that's kind of this new emerging ecosystem, but there's a lot of things we don't know yet. But and for the dollar, it's actually a good thing because 99% of stable coins are backed by the US dollars. And then the other angle is that the hope, I think, of the folks in the White House is that if stable coins become this multi-trillion-dollar asset and they have to be backed by treasury bills, then that finds a home for treasury buyers that we may not have right now. So I think there's a little bit of an ulterior motive in that sense as well.
That is so fascinating. What would you say of the analogy of, at this stage, you can see how stablecoins are going to evolve and be a lot more complex ultimately. But if you have X company issuing X number of stablecoins, how far off is that from imagining it as a gift card?
Yeah, not far off at all. Like Fidelity could issue a token or its own stable coin. And so if a new generation are just operating and managing their cash flows in this new virtual blockchain on-chain world, and the banks are kind of, okay, that's for your parents, but we're not, the young people are too hip for that. Then you have these two parallel systems, but I don't think one will ever replace the other, because if you need a loan, you're still going to go to a bank, or if you get a mortgage, it can all get tokenized, even securities, ETFs, mutual funds, it can all get tokenized, but it doesn't really change the fact that ultimately the stablecoins are a off and on rail ramp, if you will, to do other things, right?
Okay.
Even if you're like, if you have used stablecoins to buy Bitcoin, and you make a ton of money in Bitcoin, and you want to buy a house, well, you still have to convert it back into like the real world money. Maybe you could buy a house with the stable coin at some point because everything gets tokenized. Maybe your house gets tokenized. But I think that's where it goes. But it doesn't replace the dollar. It doesn't replace the banks. The banks will find a way to compete and to integrate with that. And so I think that's, I don't think it's disruptive in that sense. But certainly if you're sending money to your second cousin in, whatever, Romania, having stable coins is going to be a lot cheaper to send than physical dollars through SWIFT.
So interesting. Okay, so all kinds of questions flooding in here about Bitcoin. I'll put just one more to you here. Do you have a sense, Jurrien, of whether flows going into Bitcoin right now are coming from cash on the sidelines, other asset classes like equities? Do you have a sense of the flows?
So slide 18. So this is all ETFs right now. So of course, the big one is BlackRock here in the US. Fidelity is the second biggest one. But you look at the yellow bars is futures open interest, and that was ramping up in the anticipation of the ETFs getting launched, a year and a half ago. And then once they got launched, the movement went from the futures market to the cash market, which makes sense. And so it's been massive flows into Bitcoin ETFs. And I think that has to do with the next chart 19. And like I said earlier, is that, like gold, you always know what you're getting. It's a store of value. It's a hard money asset. And it's going to do what it does based on that single variable. Bitcoin is trying to do the same, but it's also affected by risk appetites in general. And so you can see in the bottom there a z-score of the global money supply. It's up, 8-9%, and the z-score of the stock market, which is up by similar amounts. So Bitcoin is having it both ways right now because risk appetites are strong and liquidity growth is strong. And that's just, Bitcoin really thrives on that. Where the money is coming from, it's a good question. It may be coming out of bonds or T-bills or bank deposits. I think this is just money that people have to play with. I don't think it's like cannibalizing the stock market or anything like that, because we're seeing similar flows into non-profitable tech, for instance. So I think it's just people just, having cash somewhere and saying, hey, I want to play this game too. And that's very Bitcoin-like. And if we go to slide 17, you can just see this 4-year cycle for Bitcoin has been very, very accurate. I created this chart like 2 years ago.
It's been following
it's still following. Yeah, it's been following it. And so I don't know if we're getting into the later innings of this particular 4-year cycle. We might be, but it's doing what it always has, which is, up and to the right. And so it's just a question of how many tailwinds or headwinds there are in terms of easy money, hard, tight money, monetary policy, et cetera.
Let's just, as we sort of close out, just a little bit of a discussion on the risks. So you mentioned the two biggest ones. Again, there's preparations, there's pricing in of certain things within the markets for sure. But as we come to August, which sometimes can be a bumpy ride or just like a low liquidity time in markets, what do you think people should be taking a look for?
What I look for the most is the 10-year yield. The dollar, I think everyone has concluded that the dollar probably has lost some of its supremacy here. But the 10-year yield, which actually now is at 4.35, but a few days ago it was knocking on 4.5 again. And so the interplay between, attacks on the Fed, who goes in there, what do they do, what does that do to the shape of the yield curve, and then what happens next. I think the 10-year yield is probably the most important indicator as far as I'm concerned, because as I always say, nothing good happens above 4.5%. And so far we've stayed below it. But, if we go to slide 9 real quick, I know we're out of time. I would call that a coiled spring. It's just been in this super tight range of 4 to 4.5, let's say. And that coil is getting tighter and tighter. And the term premium, meanwhile, is rising, and it's now at about 80-something basis points. To me, this is the most important thing, because if this goes the wrong way, pressure will build on the Fed. And, if you get a Fed puppet in there next year who not only cuts rates too much, but also does yield curve control, that may be great for risk markets like Bitcoin, would just go to the moon if that happened. But it's not good for the largest, economy in the world and the central bank of the world to be doing things that undermines its own independence. So that's something I think about as a kind of an existential risk.
Okay, it's amazing to see where these markets have gone and the moment that we're in. And thank you so much for setting us up for this week. As always, Jurrien Timmer, have a great week.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.